The effective interest rates takes between 3 and 6 months to go through the economy. So if you want to think about the interest rate impact, we've got to go back up to 6 months and look at what the interest rate was then. So we've had quite a few interest rate increases since then that haven't impacted fully in the economy yet. So it might be that where we are now on interest rates is enough, but the RBA continues to increase it. Again, that increases the risk of a big slowdown.
One for Mum, one for Dad, and one for the country.
And there has never been a more exciting time to be an Australian.
Budgets are about choices, Fran, and you show what you value through the choices you make.
This is coal. Don't be afraid. Don't be scared.
The Treasurer knows. I want an economy that works for people, not the other way around.
We'll just end up being a third-rate economy, a banana republic.
Just follow the money.
G'day and welcome to Follow the Money, the Australia Institute's podcast that explains big economic issues in plain English. I'm Ebony Bennett, Deputy Director at the Australia Institute, and in today's episode we're going to talk about interest rates, the issue on lots of people's lips.
Australians have been hit where it hurts for the 9th consecutive time.
Australia experiences its 9th straight lift.
Fastest and largest interest rate hike cycle on record, with the Reserve Bank today lifting the cash rate for the 9th consecutive time to 3.35%.
3.1% to 3.35%.
Households with a loan of $750,000 are paying over $1,300 more each month.
Month after month after month. These are big rises.
The Reserve Bank started raising rates back in May because of surging inflation running at around 7.8%.
Well, they're obsessed with controlling inflation. They know the cost, they know the pain, they think it's worth it.
The big banks have started passing on the hike to their mortgage customers in full.
Well, you'll be shocked to learn that the extra 0.25% has been entirely passed on to borrowers, but not quite to savers.
Warning of further rate rises in the coming months to help bring down inflation, making the dream of owning a home even further out of reach.
On Tuesday, the Reserve Bank of Australia raised interest rates for the 9th time in a row in an effort to combat rising inflation. The official cash rate is now 3.35%, and the RBA governor flagged that there may be more rate rises to come. But is raising interest rates the best way to tame inflation? How do these interest rate rises impact the rest of the economy, in particular, people with mortgages? To explain what's going on, I'm joined by Matt Grudnoff, Senior Economist at the Australia Institute. G'day, Matt.
G'day, Eb.
So let's start with the basics, Matt. What did the RBA do on Tuesday?
Well, they increased the official cash rate, which is the interest rate that all other interest rates are based on. So when the RBA increases the cash rate, that basically flows through not just to mortgage interest rates, but also to business loans, to personal loans, all the kind of interest rates that banks and other financial institutions put out.
And as I mentioned in my introduction, it's kind of the 9th interest rate rise in a row. Why is that a big deal?
Well, it's a big deal because it's one of the fastest increases in interest rates Australia's ever seen since basically the 1990s. And that's important because the RBA is increasing interest rates to try and control inflation. And inflation's quite high at the moment. But interest rate increases don't just reduce inflation, they also have a big impact on the economy. So what we're seeing now is also retail trade figures, which is basically consumer spending. They've gone backwards. We've seen the unemployment rate tick up a little bit. Basically, we're seeing a real softening, if to use the economic term, of the economy, which basically means the interest rates are working and people are spending less and less economic activity is happening.
So just explain to me in a little bit more detail why inflation is bad and why reducing inflation is the RBA's key aim at the moment.
Well, inflation is bad if your wages don't keep up with inflation. So at the moment, the inflation rate is a tad below 8% and wages are a tad above 3%. So there's a 5% gap there. That means that over the last 12 months, the stuff you buy has gone up far faster than your income, so you can buy less stuff. So we obviously see that as cost of living pressures. So you can't afford as much stuff, it's putting pressure on budgets. And the RBA is increasing interest rates to try and fight inflation. And basically the RBA's reasoning is if it takes demand out of the economy, then businesses can't increase their prices as much. So inflation is basically when prices go up. Businesses are the ones that decide what prices are, so they're the ones putting prices up. And if suddenly their consumers aren't buying as much stuff, they're not in a position to increase their prices. And so that will reduce inflation.
Interest rate hikes are designed to take money out of the economy, to stop people from spending, to lower inflation. But when you're having that kind of dramatic impact over half of all Australian households, the effects could be quite devastating on Australian business and then, of course...
Are finally starting to bite. Retail sales now is finally down in the month of December. That will be...
We do have a 3-point plan to address this inflation challenge in our economy, provide responsible cost of living relief without adding to inflation, deal with the issues in our supply chains, including the workforce issues and skills shortages, and show spending restraint in the budget.
So the RBA is at the moment raising interest rates. That's their main tool. How effective is raising interest rates the best way to reduce inflation? Will this interest rate rise, for example, help reduce the price of gas?
Yeah, that's a great question. So the first thing to know is putting up interest rates, the objective is to make people poorer so that they spend less, and the objective is to make unemployment higher. Unemployed people, when you lose your job, you don't spend nearly as much money because you're suddenly you're not earning an income. And so that's their objective. Is it effective? Well, that depends on what kind of inflation you have. And your question kind of talking about the price of gas is a really important one. If the inflation is caused because the economy is going gangbusters, it's growing rapidly, firms are unable to find labour, they're finding that there's too many consumers want their goods, then interest rates are great at controlling that kind of inflation because it basically takes demand out of the economy. It reduces demand, and it's excess demand that's causing the inflation.
So people can't buy as much stuff, therefore prices start to come down.
That's right. Or they don't increase as fast.
Yeah.
But there's another kind of inflation, which is on the supply side, on the firm side. And basically, if the inflation's caused by costs of stuff going up, so for example, fuel prices going up, petrol prices going up, increases in kind of vegetables and fruit caused by floods, for example, which is a particularly good example at the moment, then really increasing interest rates is not going to affect that. Increasing interest rates is not going to lower the world price of oil. It's not going to lower the world price of gas. It's not going to suddenly make lettuces or potatoes or whatever has been flooded out appear in the market and reduce the price. So that kind of inflation, it's far less effective. That said, if you push the Australian economy into a recession, if you keep increasing interest rates until it pushes into a recession, recessions usually cause inflation to fall because we have massive increases in unemployment and massive decreases in demand.
But generally speaking, economies are trying to avoid recessions.
Oh, absolutely. Recessions are the worst. While the RBA would definitely disagree with me, I firmly believe that recessions are far worse than high inflation.
Yeah.
So, real wages falling, that is bad. Worse than that is a recession. The question really at the moment is that what Philip Lowe, the Governor of the Reserve Bank, thinks? Is that what the Reserve Bank Board thinks? Because at the moment, from their language, they seem to be saying they're willing to do whatever it takes to stop inflation. And whatever it takes might mean pushing the Australian economy into recession.
The RBA is really walking a tightrope here, trying to control inflation without pushing the economy into a recession.
Economists believe there is a growing chance Australia will fall into a recession, and the Reserve Bank's aggressive rate hikes are largely...
Some economists believe there's a 70% chance we could pass that tipping point next year.
So they've flagged additional interest rate rises in the future, which it sounds to me like a lot of economists weren't necessarily anticipating. But this week that's raised enormous concerns, in particular about how this 9th consecutive rate rise with more to come could cause problems in the housing market in particular. Why is that? What is the concern there that this interest rate rise will have that impact on the housing market?
Yeah, so the biggest group that interest rate rise impacts is mortgage holders, and in particular, it tends to be first home buyers i.e. younger home buyers, who, when you first get into the market, that's when you borrow the most. So they're the ones that bear the brunt of this increase in interest rates. They're the ones that hurt the most. And if you bought in the last couple of years when prices had increased quite dramatically, you might not have much of a buffer. Usually younger people are on lower incomes. They don't have as much reserves behind them. And they're the ones that are really going to hurt. And how does that affect the property market? Well, if you suddenly push interest rates up too far and too many people go, well, I can't afford my mortgage now, I have to go and sell, then you have a lot of distressed sellers on the market, and that can push property prices down. And of course, if property prices go down too far, then the amount that you get for the house might not be as much as the loan. We call that negative equity, and that can cause some real problems for people too.
15% of all households would end up underwater. They wouldn't have enough money to pay the mortgage, let alone buy food or cover the expenses for anything else.
1.5 million households with a mortgage are already under pressure.
If I compare the number in stress now pre-COVID, it's up by 10%. So we've got many more people in financial difficulty.
And part of the reason, correct me if I'm wrong, Matt, why people are so concerned is that the Reserve Bank governor a few years back kind of indicated to people that he wasn't expecting interest rates to rise until 2024. That hasn't turned out to be the case at all. How did that impact people? What did they go and do in response to that public comment from the RBA governor?
Yeah, so during the pandemic, when we were in recession and the RBA was really worried that demand was too low, the governor went out and said some pretty extraordinary things for a governor. Now, they might not sound extraordinary to the rest of us, but governors of reserve banks are really, really boring people, right? They use their language very, very carefully. It's always well caveated. They don't say anything too exciting, and what he did is he basically came out and he said, look, I don't think interest rates are going to come up until 2024. And the reason he said that, and he said it so emphatically, was that he wanted people to borrow lots. He wanted people to spend. He wanted to create demand in the economy. He wanted the low interest rates, and they basically reduced interest rates to almost zero. He wanted people to rush out and spend. And what did people do? They did exactly that. We saw house prices increase dramatically. We saw people going out and borrowing lots of money. And they did so because they thought, well, interest rates are going to be near zero, the cash rate anyway, for quite a number of years. So, even if I go out and borrow now and I'm a bit on the edge, I've got 4 or 5 years to kind of get a bit of a buffer. But what's happened is Philip Lowe, the governor, got it completely wrong, and he's increased interest rates a lot earlier, and he's basically very red-faced about it. But it hasn't stopped him from increasing interest rates and basically pushing up the cost of people's mortgages.
Yeah, that's right. Back in October, shortly before Dr. Philip Lowe issued that apology about, sorry that you all took notice of what we said and went out and borrowed money.
My concern is with the substantial portion of people with a mortgage who will go from a very low fixed rate onto a higher variable.
Another rate rise just as Sandra's low fixed rate loan comes to an end.
Come off and go variable. So they're going to go from an interest rate of 2% and less to 5.5 to 6%, which is a massive increase.
And there's a number of people who I'm sure will have locked in those low interest rates, but that doesn't last forever, does it?
No, exactly right. So locking in an interest rate is only for a period of time. And so what we've got right now is a group of people who had their interest rate locked in, and so they haven't seen the rises since May last year at all. And as they come off, rather than coming off sort of incrementally, so if you had a variable rate, you've seen it go up by 0.5% or 0.25% each month, they're basically going to see a massive increase in their interest rate suddenly when that interest-free period ends. And a lot of those are going to be ending over this year.
So looking ahead, Matt, and just thinking about the RBA, I guess, because obviously, and we might go into this in future podcasts, there's things that the government can be doing to reduce inflation, but we're really just talking here about interest rates and the RBA. What can we expect looking ahead, given what the RBA governor or the Reserve Bank said, yesterday when they increased the interest rate?
Yeah, that's a really good question. Well, it's tricky to know. So the RBA are predicting that there will be multiple interest rate rises over the next few months. Now, remember, the RBA also predicted that interest rates wouldn't increase till 2024. So whatever predictions you have from any economist, you should take with a grain of salt. But at the moment, while a lot of economists were thinking that we'd almost basically peaked on interest rates, and this most recent increase might have been the last one, or at least the second last one, because inflation had peaked and looks like it's going to start coming down. The RBA is saying no. The inflation rate is still well above their target band. So their target is to try and get inflation between 2 and 3%. It's almost 8%. And so they're going to keep going and they're going to keep increasing interest rates. But another reason that economists thought they might have peaked is because the data coming to us on retail sales, on unemployment, on those sort of things, shows weakness. And also, just because the RBA increases interest rates today doesn't mean tomorrow that we see the full effect. In fact, the effect of interest rates takes between 3 and 6 months to go through the economy. So if you want to think about the interest rate impact, we've got to go back up to 6 months and look at what the interest rate was then. So we've had quite a few interest rate increases since then that haven't impacted fully in the economy yet. So it might be that where we are now on interest rates is enough, but the RBA continues to increase it. Again, that increases the risk of a big slowdown.
So if you've got big savings in your savings account, interest rate rises are good for you because you'll be getting more interest on your savings. But if you're one of those people who has a large mortgage or is potentially coming off a fixed rate loan period, just thinking of those months ahead, how often does the RBA meet, Matt? How regularly are interest rate rises potentially going to go up?
They meet on the first Tuesday of every month, except for January. They get January off. And so they'll meet February, their next meeting. We just had the February meeting. The next meeting will be in March, and then they'll meet every month after that. And every month they'll think about it and have a look and decide whether they want to increase interest rates. And it's really interesting thinking about, there are some winners from higher interest rates. If you've got savings, then you're going to get a bigger return. But there is... When we increase interest rates, or when the RBA, increases interest rates, they're trying to control demand in the economy. But that's not the only way we can control demand on the economy. It's just historically we've decided that interest rates are the way we do it. You could have like a special levy on your income tax that increased or decreased depending on whether the government wanted to increase demand or decrease demand. But instead we decide that we're going to target, so we're targeting one group, mostly mortgage holders, but also business loan holders and other people who own loans. They're the ones that are bearing the brunt of this trying to reduce demand, and in particular young mortgage holders. But people need to understand that that's just a product of history. We could do it in an entirely different way, and we could spread that pain more evenly if we wanted to.
But let's just keep doing things the way we always have done, Matt.
Exactly right. And let's not worry about young people with big mortgages.
Thanks, Matt. I think that's all we've got time for today. This episode was recorded on Wednesday, the 8th of February, and things may have changed since recording. If you liked today's episode, please rate and review Follow the Money because it helps other people to find the show. And if you love the show and want to help us continue to do work with impact and influence, please consider supporting the Australia Institute with a small tax-deductible gift today at australiainstitute.org.au. You can visit our website for all our latest research and content, and we're on Twitter at the Oz Institute with an AUS. I'm on Twitter at Ebony_Bennett with a _N_T, and Matt Grudnoff is at Matt Grudnoff. Our producer Jennifer Macy is at Jennifer Macy. Additional editing by Emily Perkins. Our theme music is by Jonathan McFeet from Pulse and Thrum, with additional music from Blue Dot Sessions. Thanks for listening.